Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Beneath the headlines, fundamentals are starting to speak louder. After past shocks from tariffs to COVID, periods like this have often pointed to more attractive long-term entry points for investors willing to look past the noise. And our next guest says this isn't about calling the bottom, it's about adding risk gradually and focusing on opportunities the market hasn't fully priced. So where is he selectively leaning in, and what still looks too expensive? How should investors manage risk from here? Joining us here today to walk us through his global playbook is portfolio manager Patrice Quirion. Patrice manages several Fidelity funds, including Fidelity International Concentrated Equity Fund, where he recently marked, just this month, 10 years at the helm. Congrats, welcome. Great to see you, Patrice.
Pleasure to be with you.
Delighted to have you here and to have some time to have conversation with you. We'll invite everyone to send questions in for Patrice over the next half hour or so. So let's begin with, because of everything that we know that's going on right now, how the approach to your fund has shifted, if at all. You're looking to the world and beyond. Has that changed in the last month?
So the last month is one of those episodes where it feels like a lot changes. And
Yes.
I think is maybe first and foremost, like as a contrarian investor, the type of events we are sort of looking forward to as an opportunity to find potentially like dislocations into the market where you can go counter to what most investors are doing and position yourself for the other side of this. So maybe like walking you through like how did we see the past month or so. I think the first thing I always start there, like when we get like big events like this, is to ask yourself, is that something that is consequential, not to like the directly impacted like regions or society, but is that consequential to the global economy? And this clearly was an event where it can be consequential to the global economy.
Right.
To call how long it will persist, which is what matters most, is nearly impossible. Like we went just like yesterday, thinking there's no end in sight, it's just escalation after escalation, and last night we get a ceasefire. So I think trying to pinpoint like when do we go all in the market is a very challenging, nearly impossible thing to do. And I see it as opportunities to look at where are stocks at? Where is that relative to our best views of fair valuation in a normal market cycle? And where do we start to have like large disconnects taking place? And the markets are efficient. Where the large disconnects take place is usually on the areas that are most impacted by what's happening. But I think
Oil, the consumer.
The consumer is a great example where, obviously like you get an oil shock, like shock at the pump, like inflation, higher interest rates that comes with it, confidence shock. So like it's a bad mixture for the consumer.
Painful.
But I think just like it was the case after the pandemic, you need to have some faith into that not being the status quo for the next 10 years. And it almost never is, right? And you start leaning against, go into those impacted areas where in a lot of cases where the stocks were already cheap, like going into this event or this like Middle East conflict we're seeing right now, and that just got even more interesting. Like it went from cheap to like another 20% cheaper, and just slowly start adding risk. Slowly start, or even maybe slightly like pick up the pace at which you are building those positions, as opposed to waking up this morning and say, oh, now I need to move like 20% of my portfolio like in the next like hour. So that's very much my approach. And we've done that across all these types of events, either like Brexit like years ago to the pandemic, to Liberation Day, to the Ukraine conflict. And this is what we've been doing over the past month once again.
So, I mean, here we are, oil price, they've dropped like a stone today. We see that indices are ripping higher. But what you're saying is, I mean, you don't need to tell us what you've been dipping your toe in, but have you been dipping your toe in prior to today and yesterday?
Yeah. Absolutely.
Yeah.
I think I would have loved to be able to tell you like we will wait and do it like yesterday. But as I said, not that easy, not realistic. So we are like slowly taking profits because the funds are fully invested. So it's always where do you allocate and where do you fund it from? And
okay, so that was one of my next questions. So it's not like you had dry powder necessarily to just ready to deploy because there's a war. Like
there was
not...
a very limited. So
okay.
I typically will run the portfolios between 1% and 5% cash allocation. Okay. For the ones of you who have been sort of following what I've been thinking and talking about for the past year, I was getting increasingly concerned about the level of optimism baked into most of the market. So the cash allocation was a little bit higher than usual. So we've allocated that.
Is that U.S. markets? Is that global markets? A little bit concerned about the optimism in U.S. markets?
Mostly in the U.S.
Okay.
That's why there was such a large underweight into the U.S. But the reality is, even in other parts of the world where I think there are still opportunities, but the reality is there were fewer and fewer opportunities. Sectors that we used to love have done like much better and has been sort of slowly divested into the portfolios over the past few years. So yeah, it was US centric, but more generalized in terms of feeling nervous about levels the markets were on. Again, we're not investing in the market, we're investing in like specific stocks. Sure. So as long as there are opportunities somewhere, we tend to find those. But there was a little bit more cash that we have deployed. But over the past few weeks, the bigger story has been taking profits on stocks that have held quite well to allocate that to other areas which are looking much more disconnected, mispriced on that normalized long-term environment view.
I mean, what we've seen, what would you call this? This is, many people are saying, one, the bottom is not in, it wasn't a full-scale meltdown. Credit spreads have cracked, but not, there's no gaping jaws or anything. So, I mean, how would you sort of rate this situation?
Yeah, so clearly, like you just look at the indices as a whole or credit spreads or whatever it might be. It was a shock, but it was not like a COVID type event. It was not even like a Liberation Day type of event. Because I think the market took the view that this cannot last. Actually,
that's what the market told us, that it was not going to last. That was the market was telling us it was not going to last.
Exactly. So it was because if it was to last, oil would not have gone to $100 or $110 a barrel. It would have gone to $200 a barrel.
Okay.
If it was to last, inflation expectations and like long-term, like 10-year yields would not have moved up like a few tens of basis points. They would have moved like full percentage points. So the market, I think rightly so, by the way, was always of the view that this is a temporary phenomenon. The world cannot live with the Strait of Hormuz closed in perpetuity. And all the big powers, not only the US, but all of Europe, including China, including India, all want the strait to be opened.
Right. It's the one thing everyone can agree on.
I agree. Right. So I think as a result, the pressure would have built in a pretty big way, as it did, on the Iranian regime to ask for different types of concessions, but there needs to be visibility on the strait being open. And it seems we're going down a path where it will be open, but Iran will be allowed to collect like tolls on ships coming through.
Maybe in Bitcoin. So we're here, according to the FT, we don't know. Well, that's all sort of
probably
to be decided. Probably, we'll have to see how that all works. So the big question for you, from us, is has the international trade, which was really the story last year for you and for many investors, and we walked into 2026 thinking that was going to continue. Has that changed? Is it back to U.S. safe haven, less international?
Yeah, well, obviously the past month has been about like reversal of that trade, right? Because the U.S. is still seen as a safe haven in general, like although maybe there's a little bit more growing doubts on like should countries like in Asia or in Europe should have as much of their assets invested in the U.S. or U.S. treasuries and like currency reserves, etc. But the reality is, although there's maybe like increasing question marks on that structurally that will play out over like years and decades, in the short term, it's still seen as a safe haven. compounded by the fact that the U.S. is energy independent, like all of America, really, and was seen as more shielded from the current events, as opposed to Asia was obviously most vulnerable, not to prices of energy, but just outright like availability of energy and natural gas and naphtha and the implication on all the petrochemical industry, etc. So we've seen that reversion. But again, I think what we need, or what I ask myself, is not so much trying to say like, oh, this will continue for X number more days or weeks, but it's more asking yourself, how do we want to be positioned when this comes to an end? Like, what do I want my portfolio to look like
Will
a
it
year
look
from now?
drastically different?
And I don't think the world will be in a drastically different place than what we were at the beginning of the year. I think we are likely to go back to this view of starting to see flows moving more into Europe and Asia. I think the fundamental observation that, generally speaking, if you look at the European, Chinese economy, we're closer to a bottom of the cycle as opposed to the US economy is closer in aggregate to a peak of its cycle.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
And the interest rate story divergence tells part of that story, doesn't it?
Yeah, I think so. So I think once this conflict is over, and it lasted long enough that it won't be instantaneous. Oil is not going to, I don't think, is going to go back to $60 like overnight. It's going to be a gradual process. But I think as that takes place, I think those trends of international diversification, better opportunity elsewhere, is likely to come back. But there's one point I would like to make, and you can frame that from my contrarian approach generally. I've been advocating of massive extremes on level of valuations, expectations on the US market versus the rest of the world for quite a few years now.
Yeah, of course.
And that reversed to some extent last year. And the international trade became a little consensus, if you can put it this way.
It absolutely became consensus, didn't it? Yeah.
So
and the concentration risk of the US markets became what you talked to your Uber driver about.
Yeah. So
which is never good.
Yeah. So when something becomes more consensus, it's also more susceptible to like sort of positioning, like reversal when something happens, like we just had. So in my case, although what I would like to bring to people's attention is, after like quite a few years of being like very underweight in the US, I went as low as 20% US exposure in the global fund when indices were closer to 2/3. I have been gradually adding back to the US market.
Is that over the course of last year, like after Liberation Day and so on?
Yes, I would say like it picked up in the second half of last year.
Okay.
Continued like in recent month, and I would say like to some extent accelerated a little bit in recent like few weeks. And while I do think a large part of the US market remains on high valuation expectations, there are increasingly pockets that have fallen out of favor. I think everything tied to the middle class consumer is in that bucket. And I've been talking about that like early this year. We were starting to prepare ourselves and like slowly starting to build positions. That has picked up in terms of pace like over the past few weeks. Like things like restaurant stocks, for instance, like parts of retail, where it's been a tough go for the middle class consumer for a long while now. And
the trough has been there for some time.
Yes,
it's been sort of
and
the
the
trough
valuations
levels.
have been declining, earnings estimates have been declining, and now it got delayed with the conflict and like the inflation, energy, like interest rate, like consequential moves. But I think we can make a case, and I think this is where we'll go back to, where that consumer that saw like its discretionary purchasing power eroded from the inflation shock post-COVID is slowly starting to rebuild purchasing power. Wages are growing faster than inflation now. Interest rates, I know, have gone up lately, but I think are likely to return on the trajectory of seeing lower interest rates that will further help. I think policies will likely continue to try to be more like middle class friendly. We're going into a midterm election. You cannot win a midterm election by only helping people at the top of that K-shaped economy.
Well, and the one big beautiful bill in the U.S. has refunds coming in next month, and so you expect there to be more of that. Do you follow the policy a little bit? I mean, when you invest in China, you have to follow the policy. That's part of it. You'll do it also in North America?
Yeah,
well,
I think
in the
we
US,
have teams helping us understand that. But I also want to be clear, like I don't think my job is to react to policy changes.
Okay.
I see it more, our job is to find what seems mispriced relative to that normalized fair value, and where do we think there is a path to getting back there, as opposed to calling catalysts that will take us back there. So I'm, longer term focus, more value focused. And I think like that general consumer economy, the real economy, and it has like a lot of implications from like consumer discretionary expenses, we talk like restaurants, but to the auto industry, the housing industry, transport industry. Like, I mean, there's a lot of repercussions from that potential. And I know people kind of saw like the past month as like this is not happening, as opposed to I see it as, okay, it delayed things, it's not happening now. But I still think this is where we go back to, and we got even more attractive entry points in some of those stocks. So as a result, we've sort of accelerated capital deployment towards that. So this is an area, it's true across the globe, including the US, and there's a lot of opportunities there. But other pockets of opportunities are being created in the US. I think healthcare,
we haven't even heard about healthcare in terms of investment. I mean, people being interested in it in some time, actually. Yep. And there's been a lot of policy noise there as well.
There is, and I think the market is just, it's exaggerating, but maybe lost interest a little bit into the sector. I still think it remains like a attractively valued, relatively defensive sector, where there are an increasing number of opportunities being created in sectors like medtech, for instance, or everything that is maybe a little bit more tied to the consumer again. Like think of like out of pocket, like healthcare related spending.
Wellness.
Dental care, like things like that. Just we've seen like massive underperformance by a lot of these stocks. Market's not paying attention, and I think it's starting to create opportunities. Like managed care as an example, that is clearly under earning now as like an area of the US healthcare system.
And there's
I
still
do believe
the
it will
trend.
normalize and it creates opportunities. That would be another area. And even within tech, like we can talk like software, which is taking
well, let's talk a little bit about the SaaS Copolyx. Exactly how you see that and what's been chucked out and what maybe was a bit too soon on that front. Are there areas of opportunity there?
I think so. I started to increasingly build positions into software. Microsoft, which is part software, part like hyperscaler. We can talk on the hyperscalers after. Is now like biggest position into the portfolio. And at first it was only Microsoft. Now we're starting to pick at some other names. I think the story of last year was probably software being like basically progressing from like an overly loved sector that was very expensive, I think, to correcting maybe more towards where it should have been. But the further like underperformance that we've seen like more recently, I think is starting to bring a lot of these companies into like a most likely scenario, sort of like outright like underpriced territory, which is starting to gather my attention on the large software companies with network effect. I think I'm still nervous on like the very niche-y bits of software that could maybe be, call it like vibe coded or AI replaced, disrupted. But I think for the large software platforms that everybody uses, like individual consumers or corporates, could be wrong, but I am of the view that those AI tools will be built on top of, as opposed to replacing that sort of core layer.
And make them more efficient, yes.
So I do think that as some of those companies are now priced for like perpetual decline, I'm willing to start taking the other side of that trade.
It's really interesting.
And even areas like hyperscalers, think like the Azure piece of Microsoft or AWS and Amazon or Google Cloud Services, there's growing pessimism around these businesses, again, from like very in favor, not that long ago when we think about it, to now the market's starting to push back on these companies saying, like, revenues are not growing fast enough for the pace at which you're putting CapEx dollars into like AI data centers. And I think one of two things likely to happen. I guess there's three scenarios, but I think one is unlikely. It's either revenues will accelerate
because they've made the investment.
Because the investment is going to be turned on, capacity is there. And if that happens, I think the market will reward that accelerating growth. Another scenario could be maybe revenues don't accelerate sufficiently. And as a result, those companies start to no longer invest. They will still invest like at insane pace.
Sure.
But
maybe
just
they pull back
a little bit. Like as opposed to growing CapEx 25% next year, maybe it grows 5%, or who knows, maybe it goes down. Which would be terrible news for the market, I think, in general. Like the AI spending has been such a big contributor to U.S. economic growth. It's been such a big contributor to the semiconductor like ecosystem, electrical ecosystem in the market, which is a lot of market cap. But we might be at a point where maybe it wouldn't be devastating news for Microsoft and Amazon or Google if revenues like keep their cadence and CapEx starts coming down back, because the stocks have underperformed because the market is saying like that disconnect like needs to converge. I guess the third scenario would be those companies are all out of their mind and spending at a pace of like many hundreds of billions of dollars a year now in uneconomical projects. I don't think that's the case.
Because
the reality,
the revenues
we are short compute.
There. The revenues are there. They have
I think
diversity
they have pricing power to some extent. I don't think they are willingly building those enormous data center clusters at negative sort of value propositions. So I don't think it will be a case where CapEx continue to goes up and revenues never catch up. Like they will charge for it. And the market is kind of debating that, which maybe creates an opportunity at the moment on those stocks.
That's really interesting. If we go further afield, go into something you spoke about last time you were here, was the international trade for Europe specifically maybe had its jump. The fiscal taps were turned on. There was going to be defense spending, some of that baked in. But what's interesting to you was some of the construction related type companies that, cement companies that probably will help rebuild Ukraine if there's peace, maybe parts of the Middle East at this stage. That continues to look interesting, those parts?
For maybe slightly different reasons. But my view is Europe, I was quite vocal and positive on Europe for a number of years, going back to the pandemic. Maybe I tuned down my optimism a little bit last year because some sectors that used to be very cheap and where we had a lot of exposures, I think got reflected. So the financial sector was a big one, right? Where
it became fully valued, perhaps.
I think it's no longer mispriced, in my opinion. So, but there are other pockets of opportunity, and I'll go back to that sort of middle class, consumer driven, tied from like receding inflation, receding interest rates, rebuild of confidence after years of deleveraging, of more elevated savings rates. Like confidence is the missing element. Obviously the last month doesn't help confidence. I think it will come back. And when it comes back, what will the consumer start spending on that it has not? The reality is like the service travel industry, this is one area that the consumer kept spending on. But where's the consumer cut back? I think like real estate, the auto industry, like those traditional like big ticket items, like purchasing like recreational vehicles, like even like apparel to some extent. This is where the consumer has really cut back.
Right.
And if that turns, where is there still like pockets of mispriced stocks that don't reflect, or that are today reflecting like a status quo, which I think is more of a bottom of the cycle type of level. And yeah, construction material companies, like selectively on the retail side, like are areas that could benefit from that, as opposed to continuing to own European banks or European defense stocks, which were very consensus.
They became very consensus. They became what everyone was talking about. Just take us to Asia at this point. We can see that China has had its own interesting reaction to Iran, which was one of its main oil providers. Things have changed. Are there tectonic shifts out of this war for Asia that you see at the beginning of any investable shifts that you see?
Investable is maybe more questionable, but I think there is like a potentially large like secular shift taking place, which we've talked about briefly in the past, but I think there is a scenario here that we are assisting at sort of like an early stage of migration of global sphere of influence superpower from the US to China.
And money going also at some point.
Potentially following that, it's all going to be gradual. I don't think you necessarily like tilt your portfolios to invest on that premise necessarily today, but the conflict that we've just seen is potentially supportive of maybe some countries historically more tied to the U.S. and the U.S. corporate system, maybe being more receptive to an alternative, and the alternative I think is clearly like China. So I think where it is investable, that's not like a 50-year like sort of time frame view, is it is happening. It's not widespread. It's not like happening very quickly, but China has gained and is gaining greater influence in a lot of the developing markets, like across Africa, across Southeast Asia, across Latin America, potentially across the Middle East to some extent, not widespread, but and the companies that can follow that sphere of influence, like the Chinese domestic champions in a whole bunch of different industries that are suddenly using that to set presence into those emerging markets and come in with now like very good products, very attractively priced, in some cases with like support given that sort of maybe growing China ties, or because their customers on the corporate side are often now like Chinese companies. It allows them to sort of start to move from being domestic champions to sort of early stage multinationals.
It's really interesting, and that's the sort of foresight ultimately that you put to work in moments like this. Like that's a much longer term thing, but it comes from the same place in terms of foresight of what will be an opportunity today for the fund, because these, just talk about moments where things do kind of fall off the ledge. And those are moments for you to go in and do some of your best hunting.
It reinforces that long-term view, but I think more importantly in the short term is to have that discipline to be willing to look past the uncertainty, keep your sight on that normalized environment, what's getting dislocated, and rotate from what is done well to what's looking more dislocated, and do it gradually, wait for the pivot point. This is what we're trying to accomplish into the portfolios. And as a contrarian investor, you look forward to those episodes. They're not fun on the way down, but creates a whole lot of opportunities to add like meaningful value on the way up. And I think we've done it relatively well in prior such episodes over the past decade or so. And I think we're in the middle of another one of those.
Okay, Patrice Quirion, delighted to talk to you. Thank you for joining us here in the studio.
Pleasure.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.